In this lecture, we're going to talk about depreciation accounting. Depreciation accounting is a method of recognizing the loss in value of an asset that has many years of service. We'll first talk about the different concepts of depreciation. Then we will give some examples from the accounting viewpoint. We will explain the straight line method, which is the simplest method of allocating the loss in value of an asset over many years. And last, we will look at profit after tax versus cash flow after tax. There are at least three concepts of loss in value of an asset. The first might be the physical deterioration of the asset. For example, if you have a pump over many years, the pump declines in efficiency. And most of you have had some experience with an automobile engine where you lose horsepower with age. You may lose market value of an asset due to market conditions. For example, the moment you drive your car off the dealer's lot or out of the dealer's showroom, it loses value because it's now a used car. Horses lose value with age. And of course, all of you have experienced the loss in value of a computer. Most of the computers that you bought several months ago are obsolete. And last, we have the decline in accounting value for income tax purposes. And that is the main subject of this lecture. Let's look at an example. Here we have a 5-year project that a company is looking at with expected revenues of $28,500 a year. Labor and materials expenses are expected to be $5,000. And this company is going to rent equipment that's going to cost $3,500 a year. This company finds itself in the 40% tax bracket. Perhaps it's a combination of federal, state, and local taxes. However that's obtained, we'll take that as the marginal tax rate. And we wish to obtain the profit after tax for this company for this 5-year project. On this table, we show the first year of operation. We have revenues, $28,500, labor and materials expenses, $5,000, the equipment rent. That leaves us with a taxable income of $20,000. Since the second and third, fourth, and fifth years are the same, we can simply repeat those lines in the table. Applying our 40% marginal tax rate, we then get a tax of $8,000 per year, resulting in a profit after tax of $12,000, and that's for each one of the 5 years. And for convenience, we can sum the columns and get the totals. So we have a sum of $60,000 profit after tax. Let's look at example 2, which is similar to example 1, but with a major difference where the company is now going to buy the equipment. So let's imagine that the company will buy the equipment for $20,000, use it for 5 years, and then sell it for $5,000. The company is in the same income tax bracket, the 40% rate, and we wish to obtain the profit after tax, and later we will obtain the cash flow after tax. So here we have in the table a very similar computation. We have the revenues in the first column, labor and materials expenses, and we have a subtotal here for total expenses. However, let's note that the $20,000 equipment expense, which occurred at time 0 at the beginning of the first year, is now recognized as an expense here for time period 1. So at the end of the first year, for tax purposes, now we're claiming this $20,000. The $20,000 plus the $5,000 gives us our $25,000 expenses in the first year. Of course, in the other years, we have only the labor and materials expenses. Also note that as a revenue item in the 5th year, we have a $5,000 revenue from the sale of the used asset. The rest of the table follows in a very similar manner. We have our taxable income in the next column. In the first year, that's only $3,500 because of the very large $20,000 equipment expense. The profit after tax computed at 40%, and then the profit after tax in the last column. This is a slightly different example, so from the viewpoint of comparing it with the first one, we shouldn't be too concerned because in this example, the company owns the equipment. It's taking a certain risk with that. So the cash flows are somewhat different. We should observe, however, that what we did in example 2 is generally not allowed, at least not in the U.S. and in most industrialized countries, and that is we allocated all of the equipment expense for a long-lived asset in the first year. There are some exceptions where you can do that, but generally speaking, you're not allowed. So let's look at example 3, where we're going to systematically allocate the equipment loss of value. But let's first define equipment depreciation expense as a systematic allocation of the loss in value of an asset. Allocation has to be prescribed by the tax law, and it doesn't necessarily follow the true economic laws. What are the factors in computing depreciation? Well, there's the initial value of the asset. That's called basis by the accountants. That's usually the installed cost. That includes freight, taxes, installation expenses, less any trade-in value. In our examples, we don't have trade-in values. The terminal value, or the expected salvage value, also goes into the computation. Then we have the time period of allocation. That's called the depreciation life or class. And finally, we have the rate of decline in the accounting value, or what we call the book value. So here we have example 3. It's very similar to example 2, the difference being that now we're going to allocate the expected loss in value of the asset. Remember, in the example 2, the company bought the asset for $20,000 and then sold it for $5,000 at the end of 5 years. We're going to take this anticipated loss in value, the 20 minus 5, or $15,000, and allocate it in a straight line fashion. You simply take the $15,000, divide by 5, and then allocate $3,000 of equipment depreciation expense. The proceeds from the sale of the equipment, that is the $5,000 at the end of year 5, are not subject to tax because we never claimed that as an expense. In this graph, we see the decline in the asset value starting at $20,000. That's the initial cost or basis of the asset. Each year, we have $3,000 loss in value. You see the book values, $17,000, $14,000, $11,000, $8,000, and $5,000 at the end of the 5th year. The $5,000, of course, corresponds to our estimated salvage value that we had anticipated at the beginning of the project. Another thing to note in this graph is the difference between the two time scales. On the graph, we show points in time, that is usually the end of the accounting year. Below that, we have a line that shows the operating period. In this example, the operating period is a year. So that, for example, time point 0 is the beginning of the first year. Time point 1 is the end of the first year, and so on. Here we have the table, at least the first part of it, for example 3. We have revenues, $28,500 per year, labor and materials expenses, $5,000, and equipment depreciation each year, $3,000. So the total equipment expense is $15,000. Then we have a subtotal for total expenses, and then as we complete the table, we'll see the taxable income. We subtract the total expenses of $8,000 each year from the revenues of $28,500, giving us a taxable income of $20,500. The 40% tax then gives us a profit after tax of $12,300. And that, of course, is for each year. The sum total is $61,500. There were two important assumptions we made. One was the end-of-year cash flow convention. We assumed that all labor and materials expenses occur at the end of the year. Equipment expenses, of course, depreciation expenses are recognized at the end of the year. The cash flows for those, of course, are at the beginning of the project. And then there's a reverse cash flow that is the proceeds from the sale of the asset at the end of the last year. Another important assumption is that the time lags between the accounting expenses and the cash flows for them, for items such as labor, materials, interest, and rent, at the end of the year, usually these time lags are perhaps 1 week to 2 weeks, sometimes 4 weeks. But these time lags are offset by corresponding time lags at the beginning of the year. In other words, the boundary effects cancel each other. And for all practical purposes, we can take the accounting expenses and treat them as cash flows for labor, materials, interest, and rent. That, of course, is not true for depreciation expense. So we have the exception given here at the bottom of the slide. Let's look at the cash flow after taxes now. For example 2. And what we've done in the first column is we have combined some of the information from the previous tables. We've taken the revenues and subtracted from that the labor and materials expenses, that is, our cash expenses. If we had rent and insurance, we would also reflect that in the first column. We call this operating cash. We have the equipment expense here. That's $20,000. That's not included in the operating cash because it's a lumpy type of expense. It's not on a regular periodic basis. And then at the end of the time period here, the last period 5, we have the $5,000 revenue from the asset sale. And in example 2, we have to include that $5,000 as revenue because we claimed all of the equipment as an expense in the first year. So in the third column, we have the taxable income, taking our operating cash, adjusting that by any equipment expense, subtracting $20,000 from $23,500 in the first year. In the other years, there's no such adjustment. Then we take our tax, the 40%. We can take the 40%, apply it to taxable income. We get our profit after tax, $21,500. And then in the last column, we have cash flow after tax. The only difference between profit after tax and cash flow after tax in this example occurs in the first year. And that is because we paid for the equipment at time 0, but we're recognizing the accounting expense for the equipment in example 2 at the end of the first year, time 1. Let's look at example 3 now. Here we have operating cash. That's the same $23,500. That is from the revenue, $28,500, minus labor and materials expenses of $5,000. And now we'll subtract equipment depreciation from that to get our taxable income. So this is operating cash. This is an accounting expense, but it's not a cash flow. But for taxable income purposes, for purpose of computing the taxable income, we recognize the $3,000 each year. So we have the taxable income, $20,500. Our profit after tax then is 40% of that each year, $8,200. That's the tax. That gives us profit after tax, $12,300. Our cash flow after tax in years 1 through 5 then is obtained by taking the $12,300 and adding back the $3,000. Because this figure has the $3,000 equipment depreciation expense in with a negative sign, negative algebraic sign. This represents all of the cash flow that we had, the operating cash, the tax, certainly that's going to be a cash flow. But we have an additional item which is not a cash flow. So in order to obtain the cash flow, we have to undo the subtraction of the $3,000. Simply adding back the $3,000 to the profit after tax then gives us our cash flow after tax, $15,300. In addition, we have the cash flow at time 0 for the $20,000 expense for the equipment, that is the investment of the equipment. And then at the end of the 5th year, we have a $5,000 item shown by the arrow. That is the proceeds from the sale of the used equipment. Because we never claimed that portion of the equipment as an expense, remember we only claimed $15,000 in expense, that is not subject to tax, but it is a very important part of our cash flow. So we can observe that a quick estimate of the cash flow after tax is to add the depreciation expense to profit after tax. That is when there's no loan involved. In some later lectures, we will have more complicated situations, and then we have to reflect the loan cash flow also. Let's look at a more detailed comparison of examples 2 and 3. Here we have, in the first column, the equipment expense for example 2, recognized from the accounting standpoint, if that were allowed. $20,000 expense we took in year 1, so that's at time point 1, and then the proceeds, $5,000. So in effect, we're claiming $15,000 of equipment expense in example 2. In example 3, we're also claiming $15,000, but we're spreading it in straight line fashion over 5 years. And notice what happens to the cash flow after tax. Although the cash flow patterns are different, the same $20,000 investment at time 0, In example 2, we have a much larger cash flow time 1 because we had a much larger expense. We compensate for that in example 3 by having larger cash flows in the later years. So the total cash flow is the same for both examples. The timing, of course, is different. The timing in this example favors, in this comparison, the timing favors example 2. We get an additional $6,800 at time 1, and then, of course, that is compensated for by the differences in favor of example 3 in years 2 through 5. So, in summary, what we have covered in this lecture are several concepts of depreciation. We talked about physical deterioration of an asset, we talked about the market value loss, and we focused specifically on the decline in accounting value for the purpose of computing taxable income. We looked at 3 examples, and we looked at the accounting details for them. In the first example, the company rented the equipment. In the second example, the company bought and allocated all of the equipment expense in the first year, something that's generally not allowed. And in the third example, the company bought the equipment and allocated the anticipated loss in value in a straight line fashion. So we covered the straight line method. That's one of the classical methods of depreciation accounting. And we looked at profit after tax versus cash flow after tax. We noticed that in our example, the sums of profit after tax and the sums of cash flow after tax were the same for examples 2 and 3. One reason for that is because the marginal tax rate did not change. The timing of these cash flows, of course, depended upon the equipment expenses and how we allocated them. And last, we obtained a quick estimate of the cash flow after tax by taking the profit after tax, which is a number that typically is computed anyway, and then simply adding back the value for depreciation, because this figure reflects the depreciation with a negative value, whereas the depreciation expense is not really a cash flow, it's simply an accounting item. So in order to get the cash flow after tax, a quick estimate is to take this profit after tax, numerically add back the depreciation expense.